All right, so how ugly?
Well, first you have to sort of put things in context, right? So, in by the way, can you hear me okay, or is there an echo? Is it all right? Yeah. So, okay.
You got me,
So,
Spencer?
yeah, I've got you, Carl. Sorry, there were some technical difficulties here. So last year we had 200 billion invested in startups this year, last year, which was up from 100 billion the year before. So, huge boom in venture investing, and also huge increase in the diversity of venture investing into other hubs outside of the Bay Area, including LA and Seattle and Miami. So that's the good news from last year. The bad news is, as we've started this year, the Fed has said the party's over, that we're in a 5 to 7% inflationary environment. And that doesn't even include housing costs, which are going up way faster. So, Picasso is forecasting double-digit rates of appreciation in second home markets. Zillow is forecasting 14% rate of appreciation in primary home markets. So if you were to include housing costs, then the Fed would see an even uglier inflationary period. So
Right.
the problem with that, of course, is that the Fed is pulling back, and therefore companies and investors are moving further in on the risk curve. So what happens is these public market valuations are coming down. That's going to impact my world, the venture world, because private companies comp to public companies, they're valued off the same rubric. Now, what's interesting is that this time it's changing. There are so many more crossover investors that are investing in publics and privates that it used to take 6 to 12 months for you to see it to move from public valuations to private valuations. That time gap is compressing faster than ever because of more crossover investors. So it's going to be ugly as the Fed raises rates. We haven't had a higher rate environment in a very long time. The good news is great companies get built through these downturns. And we've seen this in 2008. We saw this in 2001. And that's because innovation continues. And there's so much innovation happening right now between blockchain and crypto and Web3 and so many other platform shifts that are occurring. So that's the good news if you take the long view.
Well, I guess my question would be, we know the damage, as we pointed out at the top of the show, has been going on for a while. I did notice the Goldman Sachs most shorted basket has given up all the gains going back to Thanksgiving of 2020. So at what point do you think that the innovation conversation starts to offset the valuation conversation?
Well, there's been a re-rating of multiples in a lot of stocks, including cloud, of course. I don't know if we've found that floor. The market is also bifurcated, where you've got the major indexes at all-time highs and the mega caps at all-time highs or near all-time highs, but then you've got small caps and mid caps that are just getting decimated. So I'm a startup founder more than a stock market picker. I guess I'd say that the trends that we're supporting, for example, the cloud companies, those trends were huge addressable market, corporations moving their whole tech stack from on-premise to cloud. Really great margins once you're at scale in these SaaS businesses. Those things haven't changed. Now, there may be a re-rating on the multiples of how public investors think about those companies, but hopefully once we're at that floor of re-rating, then those companies grow into that multiples, and the particulars of why they were trading as such high flyers previously, those start to rebuild from there. And I take a very long-term view. I'm not a short-term trader, so I'm still incredibly bullish on technology and incredibly bullish on tech stocks. I think over the long term, they will outpace the slower growth companies.